Same $500 a month, same 30 years, same stock market. One person ends up with $1,118,000. The other ends up with $745,000. That's a $373,000 gap between two people who did almost the exact same thing. By the end of this video, you'll know exactly which number you're going to be aiming for.
And it's not decided by luck. It's decided by three numbers most people never check. Stick around. The third one is the one nobody tells you about.
Quick question. When you buy a single stock, what do you actually own? You own a piece of one company. Apple, Tesla, whatever you picked. Your money rises and falls with that one business.
A mutual fund is different. It's a pooled basket. Your money mixes with thousands of other investors, and a manager, or an index, spreads it across dozens, sometimes hundreds of companies at once. So here's the real question this video answers. Does spreading your risk across many companies make you richer, or does picking the right single company make you richer faster? Before you run the numbers, here's the scale of who's actually in this game. The Investment Company Institute's November 2025 report found 56.4% of U.S. households own mutual funds. Gallup's 2025 survey found 62% of Americans own stock in some form. Notice those numbers overlap. Most people aren't choosing stocks or mutual funds. They're doing both, without realizing which one is actually driving their results. And here's the sharper number. Recent Federal Reserve household survey data shows the wealthiest 1% of Americans hold more equity than the bottom 90% combined. Question: if most people already own a mix of both, why does the average household still end up behind? Let's put real numbers on the table. Same investor profile for all three paths. $500 invested every month, 30 years, same overall stock market conditions. Path 1, Michael buys individual stocks. Path 2, David buys an actively managed mutual fund. Path 3, a low-cost index fund, just for comparison. Which one do you think wins? Hold that answer. We're about to check it against real data, not guesses.
Here's the first number that decides everything: the fee. Industry data for 2025 puts the simple average expense ratio for actively managed equity mutual funds at 1.10% a year. David's fund charges this. A low-cost index fund averages 0.14%. Some go as low as 0.05%. 1% doesn't sound like much, right? That's exactly what the fund industry is counting on.
Run David's $500 per month at a 8.9% net return after that 1.1% fee for 30 years. David's mutual fund, $896,521. Now run the same $500 per month through a low-cost index fund at 9.95% net. Index fund, $1,118,260. Same contributions, same 30 years. $221,739 difference, created entirely by a fee that looked too small to matter. Question: if the fee is this small on paper, why is the gap this big in your bank account?
Now, Michael, the stock picker. Individual stocks have zero built-in expense ratio, no annual fee eating into his balance, so shouldn't he win by default? Here's where it gets uncomfortable. Investor behavior research comparing what people actually earn versus what their funds and the market earn found this. Over the decade ending December 2024, the average investor's real-world return was 7.0%, while the investments they held returned 8.2%. That's a 2-point annual gap. Not from fees, from behavior. Buying after a stock has already risen, panic selling in a dip, chasing whatever's trending. Run Michael's $500 per month at that real-world 8% net rate for 30 years. Michael's stock picking? $745,180. Question: Michael paid no fee at all, so why does he end up $373,080 behind the index fund investor?
Maybe Michael thinks he'll be the exception. the one who beats the market by picking better stocks than everyone else. Here's what the data says about that bet. Independent 2025 benchmarking research on fund performance found that 79% of actively managed large-cap U.S. funds failed to match the S&P 500 that year, one of the weakest showings in the study's 25-year track record. And that's professional fund managers, people who do this full-time with research teams, access, and decades of experience. Zoom out to a 15-year window, and over 90% of them still couldn't keep pace with the index. Question: if 9 out of 10 professionals can't beat the market over 15 years, what are the odds an individual investor trading part-time actually can? Let's not just look at year 30. Let's check year 20, because most people don't wait 3 full decades to ask, is this working? At year 20, same $500 a month. Index fund, $377,232. David's mutual fund, $329,733. Michael's stocks, $294,510. The gap between Michael and the index investor at year 20 is already $82,722, and it widens every year after that, because compounding doesn't just add, it multiplies. Question: if the gap is already this big at year 20, what does one more decade of the same pattern do to it? Here's what the dollar totals don't show you: how rough the ride was to get there. A single stock can lose 30, 50, even 80% of its value in a bad year, and it has nothing to hedge that fall. If Michael's 1 or 2 picks are concentrated in, say, 2 or 3 companies, one bad earnings report can wipe out years of gains overnight. A mutual fund, even a mediocre one, is spread across dozens or hundreds of companies. One company collapsing barely moves the needle. Here's a real example. An investor holding a single stock that drops 50% needs a 100% gain just to get back to even. An investor spread across 500 companies, where a handful drop and others rise, rarely faces that math at all. Question: is the extra return Michael is chasing actually worth the chance of needing a 100% comeback just to break even? Here's a mechanism almost nobody explains. You can owe taxes on a mutual fund even if you never sold a single share. When a fund manager sells winning stocks inside the fund to rebalance or lock in gains, that gain gets distributed to every shareholder at year-end. You get a tax bill for a decision you didn't make and a sale you didn't request. Index funds trade far less internally, so this hits mutual fund investors, especially actively managed ones, much harder over time. Question: how much of David's better-than-Michael fee-adjusted return just quietly disappeared into a tax bill he didn't see coming? Quick clarification, because this gets confused constantly. An ETF isn't a third category. It's structurally a fund, like a mutual fund, but it trades like a stock all day, and its share creation process triggers far fewer taxable events. That's a big reason index ETF costs average around 0.14% versus that industry-wide simple average of 1.10% across actively managed equity mutual funds. So the real dividing line was never stocks versus funds. It's index versus active management. Question: now that you know that, does the title of this video still mean what you thought it meant at $0? Let's answer the title directly. Richer? Over 30 years with real current data, the index fund investor wins by a wide and widening margin. Not because the market treated them better, because they paid less and reacted less. Faster is a different question. A single stock can double or triple in a year. NVIDIA investors know this. But for every stock that does that, far more go sideways or lose value. And the data shows that even professionals paid to find the winners fail 79% of the time in a single year. So faster is possible. Faster reliably for most people is not what the numbers support. Not quite, but the data tells you where stock picking realistically belongs in a plan. Financial planners commonly point to a simple structure. put the bulk of long-term retirement critical money, the money you can't afford to get wrong, into low-cost index funds. Then, if you enjoy the research and the risk, carve out a small percentage, often cited around 5 to 10%, for individual stock picks. That way, if Michael's picks do well, he gets the upside. If they don't, it doesn't erase 3 decades of compounding. Question: is your current mix closer to core index, small side bet? Or is it closer to hoping 1 or 2 stocks carry the whole retirement? Pull up your own mutual fund or 401k and find its expense ratio. It's public information. Most people have never looked. Check if your fund is actively managed or index. The name alone won't always tell you. Read the fact sheet. If you trade individual stocks, track your actual return versus the S&P 500 for 1 full year. Not your best pick, your whole portfolio. Most people are shocked by the number. Check how concentrated your stock picks are. If 2 or 3 companies make up most of your position, you're carrying single stock risk without realizing it.
The market doesn't decide who gets richer. The fee, the behavior, and the tax bill you never checked do. Everything in this video is based on publicly available 2025-2026 industry and government data on fund fees, fund performance, investor behavior, and household investing patterns. Check your own numbers this week. They're sitting in an account you already have.
Thanks for watching. See you in the next video.